Good morning, everybody. The clerk has advised me that we have quorum, so I'd like to call a special meeting to order. Welcome. First of all, I'd like to welcome Colin Lynch to the Investment Board. Mr. Lynch was appointed by City Council last week and joins us today for the first time, and maybe, Colin, we'll give you 30 seconds to give us a big hello. Over to you.
Well, thank you. It is a pleasure to be here. It is my second city appointment, and I'm glad to be involved and look forward to contributing.
Thank you. We have a new clerk. Some of you may have noticed in the emails, Sylvia Pachesjetsky. And I butchered her name as usual. She's clerking the meeting and will take care of all your needs. The meeting is being held using the city's WebEx technology with members and staff connecting via video conference or calling in. Because we're meeting remotely, we ask your patience with any delays, technical issues. Members of the public can observe the meeting on YouTube at youtube.com, Toronto City Council Live. I'd like to request that staff keep their video turned off unless they need to speak or answer questions. It'll make it easier for me as chair and for those watching on YouTube to observe members as they participate in the debate on each item and during votes. I'd also ask that all members and staff keep their microphones on mute unless you need to answer a question or to speak. If any members wish to speak on an item, please make sure your video is on, raise your hand or unmute your mic and indicate your intention to speak, and I'll create a speakers list. When voting, I'd ask members to make sure your video is turned on and you raise your hands to indicate your vote. Although we are in different locations and meeting remotely today, the board would like to acknowledge that we are in the land meeting today is on the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat peoples. It is now home to many diverse First Nations, Inuit, and Métis people. We'd also acknowledge that Toronto is covered by Treaty 13 with the Mississaugas of the Credit. Let's start off with, are there any declarations of interest under the Municipal Conflict Interest Act? If you have an interest, please raise your hand or unmute your mic. Seeing none. Did you raise your hand, Sharon, or were you just waving? Okay. Seeing none, the item for this meeting is IB 8.1, one-year extension of electronic meeting rules. I'm sure everybody has read it all. If you don't approve this item, that'll be the end of the day because we won't have the next meeting. Any questions of staff on this item? Any speakers on the item? Do I have a motion to adopt the staff's recommendation? Could somebody raise their hand? Pamela, thank you. All those in favor? Opposed? The motion is carried. The special meeting is adjourned, and we will have our next meeting in approximately 6 minutes. Thank you all.
Should you be
Good morning, everyone, again. The clerk has confirmed that, again, we have quorum, so I'd like to call the meeting number 9 to order and welcome everyone. The meeting is being held using the city's WebEx technology with members and staff connecting by video conference or calling in. Because we're meeting remotely, we ask for your patience with any delays or technical issues. We do not have any registered public speakers today, and members of the public can watch the meeting on YouTube at youtube.com Toronto City Council Live. I'd like to request that staff keep their video turned off unless they need to speak or answer questions. We'll make it easier for me as chair and for those watching on YouTube to observe members as they participate in the debate on each item and during votes. I'd also ask that members and staff keep their microphones on mute unless you need to answer a question or speak. If any members wish to speak on an item, please make sure your video is on and raise your hand or unmute your mic and indicate your intention to speak, and I'll create a speakers list. When voting, I ask that members make sure your video is turned on and raise your hand to indicate your vote. Although we are in different locations and meeting remotely today, the board would like to acknowledge that the land we are meeting on is the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and Wendat peoples, and is now home to many diverse First Nations, Inuit, and Métis people. We also acknowledge that Toronto is covered by Treaty 13 with the Mississaugas of the Credit. Starting off, are there any declarations of interest under the Municipal Code, Municipal Conflict of Interest Act? And if you have an interest, please raise your hands or unmute your mic. Seeing none, may I have a motion to confirm the minutes of both our special meeting and our regular meeting on July 8th. Can I have a motion from someone? Sharon? All in favor? Can everybody raise their hand? Good. Opposed? Carried. Let's proceed with items on the agenda. We'll start with first item is IB 9.1, presentations from investment managers. We have 2 presentations on this item. Are the managers on yet? Yeah. Are they on the, they're on the WebEx? Okay, I just remind each one of them, just in the interests of time and to give the members time to ask questions, whether they should limit their presentations to 10 minutes each. First presentation is from Leith Wheeler Investment Counsel Limited. I'd invite Jim Gilliand, President and CEO and Head of Fixed Income, and Ben Homsley, Portfolio Manager, Fixed Income, to give their presentation. So over to them. I see Jim there. I see... There's Ben. The floor is yours.
Well, thanks very much, Chair, and thanks for having us here this morning. My name's Ben Homsley. I'm a portfolio manager with the Leith Wheeler Investment Counsel, and I specialize in servicing our large institutional fixed income clients, including the city. I'm joined today by Jim Gilliland. He is our firm's president and CEO and also our head of fixed income. And I would just like to start our presentation by saying thank you for entrusting our firm with the capital of the City of Toronto. It is both an honour and a huge responsibility, and so it is our pleasure, a pleasure for Jim and myself to have the opportunity to present to the board today. Is the clerk controlling the slides for people? If they could turn to slide number 2. And I'll carry on in the meantime. But I just thought that given that our mandate is still relatively new, and I also understand that there are some new board members since I presented to you last year, I thought it would be make sense to just provide a quick refresher on who is managing your portfolio. Leith Wheeler is one of Canada's few remaining independent investment firms, and one that is entirely owned by its employees. Our firm has been managing investments for almost 40 years, and we currently manage a little over 20 billion Canadian dollars in investments for primarily institutional clients across Canada, including pension plans, foundations, endowments, corporations, public sector entities, including the city, and as well as First Nations and a number of private clients. If you could turn to page 3. Our firm invests primarily in public markets, including Canadian equity and fixed income. And in fact, fixed income represents almost half of our firm's assets under management. Most of the fixed income we manage is invested in the same or a very similar core bond fund strategy to what we manage on behalf of the City of Toronto, such that the strategy we manage for you is a significant focus of our business. And I'll hand over to Jim now on page 4.
Yeah, I just wanted to give you a representation of the investment team that's involved in managing your portfolio. There's 10 professionals that are focused on our fixed income investments. I joined Leith Wheeler just over 10 years ago, and a lot of the focus was building up our capabilities, whether it's people, technology, to support our fixed income effort. We're very fortunate with the employee ownership structure that Ben discussed, that we have very low turnover. We've never had an unplanned departure on our investment team. And so that gives you confidence that the individuals, the professionals that are managing your investments today will be the ones that will continue to manage them in the future. In addition, we're very proud of the diversity of managing our team, both in gender, ethnicity, backgrounds, but ultimately it's the diversity of thought that we think is important in terms of bringing investment ideas together. Just in terms of page 5, alongside the diversity of thought, what we've also distinguishes our firm and our investment approach is our investment in technology, and that's to provide a set of quantitative tools so that we can effectively understand the risk within your portfolio. This is something I brought to the firm from my previous work at Barclays Global Investors and HSBC Asset Management. And ultimately, it's the focus on risk, which is in the upper right box on page 5, which has helped us deliver the consistency of our returns over the past decade. And our aim is to ensure that your capital is invested not just in a diverse set of government corporate issuers, but also a diverse set of strategies, so interest rate strategies, credit sectors, individual securities, so that when taken together, this portfolio really represents our best risk-adjusted returns that we can deliver for your portfolio.
So if the clerk could just turn to page 6. Part of our framework for assessing risk includes an assessment of the environmental, social, and governance factors that could impact the performance or holdings in your portfolio. And, what makes, I think, our firm stand out in this regard is that we've been incorporating these E, S, and G factors into our decision-making, probably from before the acronym ESG even existed. This slide here shows you a presentation from 2010, where you can clearly see that our analysts are asking exactly the sorts of questions to management and taking the critical factors into consideration related to ESG when making their investments. If you turn to page 7, you'll see that over the past decade, we have been very pleased to see how these ESG factors have evolved and are achieving far greater attention in the industry as a whole. This has been through the formation of organizations and associations such as the UNPRI, the Canadian Coalition for Good Governance, and these are organizations that we have participated in and been very supportive of. In addition to that, though, we have taken our own steps to formalize our ESG assessment in our fixed income and our equity portfolios by augmenting our understanding of these companies, the companies that we invest in, with third-party analysis and ratings. And the example here we use is MSCI's ESG system. So if we maybe change gears on page 8 and look at your portfolio, at a very high level, your portfolio is, your capital, I should say, is invested in 2 different portfolios. The first is an actively managed portfolio that we are going to cover in more detail in the remainder of the presentation. We would like to take this opportunity to thank the investment board for the additional investment of $168 million from November of last year. And in addition, we wanted to highlight The second portfolio, which consists primarily of municipal bonds that were purchased by your previous internal investment team. These bonds were purchased with the intention of holding to maturity, and they are not as actively traded in the market. And as a result, we are monitoring this portfolio for opportunities to liquidate these bonds, but they do not form part of the actively managed strategy that we're reviewing for the remainder of this presentation. I would add that in addition, over the prior 12 months ending 30 September, we are pleased to report that we have found some liquidity for these bonds, these municipal bonds, and have been able to sell approximately 24 million of this portfolio, which alongside an additional 4 million of coupon payments has resulted in us being able to transfer 28.2 million out of the inactive portfolio, and we have reinvested these funds in the actively managed strategy.
And if you turn to page 9, the active portfolio we have constructed on your behalf is invested along the lines of the pie chart you see on the right-hand side. It's a combination of federal, provincial, municipal, and corporate bonds. It's primarily invested in nominal bonds, so those are bonds with a fixed coupon. However, we do have a small allocation, about a 1% weighting in real return bonds. So these are issued by the Government of Canada and provide inflation protection as well as a real yield on top of that. Portfolio has duration interest rate sensitivity of around 8.5 years. That means roughly a 1% movement in yields will move the price of the portfolio about 8.5%. And finally, the portfolio yield is about 1.4%. Gives us a slight yield advantage relative to the benchmark at 1.3%. And that is typically one of the strategies that we employ to be able to deliver some additional value on top of the yield available from the index. In terms of how we get that additional yield, you can see our weighting in corporate bonds is around 41%. These are primarily short-term corporate bonds, so bonds that are scheduled to mature within the next 5 years. We're also currently overweight provincial bonds. We find that the additional yield advantage relative to Government of Canada bonds is quite attractive. And when we're looking at higher quality credit, our focus in terms of industry is tended to be more along banks and regulated utilities, so the higher quality portion of the Canadian marketplace.
So if you can just turn to page 10, this is the summary of the investment returns within your portfolio. And the first thing you'll notice is that the absolute returns have been very strong. Year-to-date returns of around 8% and close to 7% since the inception of the portfolio back in June of last year. This is primarily due to the sharp decline in interest rates during 2020 in response to the pandemic. Although it is slightly offset by a widening in credit spreads. Year-to-date, credit spreads on corporate bonds are about 35 to 40 basis points wider on average. Your portfolio's performance was positively and negatively impacted by different active positions we took during the past year. On the one hand, we were positioned slightly overweight duration, meaning that your portfolio benefited from the decline in interest rates even more than the benchmark. And we were also able to take advantage of the widening in credit spreads to add to our credit exposures and then benefited as credit markets rallied back in the second half of 2020. However, your portfolio was, on the other hand, adversely impacted by the fact that throughout the pandemic, we were very slightly positioned overweight credit within the portfolio. Although it was high quality credit, the sell-off that occurred in March in particular was quite indiscriminate in terms of which issuers were sold. And then we also had a small overweight position, as Jim mentioned earlier, to real return bonds that are susceptible to changes in inflation expectations, which declined quite sharply as a result of the pandemic, and quite unexpectedly, as I'm sure we're all aware, back in March.
So I want to be respectful of committee's time, but just on page 11 as our conclusion, we just had a few bullet points on the market outlook, and I'll give a very quick summary, and then we can open it up to questions you might have. What we like to highlight first is the policy measures, both in terms of spending on the fiscal side of government programs, as well as on the monetary side in terms of interest rates and supporting capital markets, have really been significant and have really helped offset some of the adjustments in the economy. We expect those measures to remain in place, and what that means in terms of your portfolio and in terms of interest rates is that we expect that interest rates will continue to remain quite low. That will depress returns in your portfolio going forward. You know, as a rule of thumb, think of your yield as a starting point in terms of the added value or the return that we can deliver on your portfolio. Inflationary pressures at this point are somewhat limited. Anytime you expand money supply, as we've seen, that does represent longer-term risks both to inflation as well as to the currency. We fully admit there's a fair amount of uncertainty as it remains to the outlook, in that we're dealing primarily with policy measures associated with a pandemic. That is going to introduce volatility as we look forward. And the most significant risk we see in terms of capital markets and returns is really more in terms of political risk, and whether the current political environment means that we see a premature withdrawal of some of the economic stimulus that is really needed at this point of the economy. So with that, I think we'll pause and just open it up to questions if that works for you, Chair.
Thanks, Jim. Thanks, Ben. As he said, let's open it up for questions from the board. If I can get my screen back and see whether... we'll start out. Matt Flynn has a question. Go ahead, Matt.
Hi, gentlemen. Thank you very much for your work on our behalf, and thank you for your presentation today. Two questions, just with respect to the portfolio construction. Can you give us a sense of how many names you own at present, firstly? And then quickly, just the top 10 or 5 largest positions?
Yeah, I'll jump in here. The portfolio has, at any time, typically between about 150 and 200 different securities in the portfolio. Within that, I would say we often own securities, multiple different securities of the same issuer. So we typically have somewhere between 70 and 100 different issuers. Obviously, we own at any time most of the provinces and typically some government of Canada. So most of that would represent corporate holdings. Therefore, in terms of the biggest positions, we do hold. Partly as a function of the relative size in the Canadian market, large positions in many of the top 6 Canadian banks. They would probably be some of the individually largest issuers within our corporate bond portfolio. We do also own issuers of some of the regulated utilities, for example, like a Hydro One, which was one of our larger issuers during over the last debate. I would add to that we're when we think about positions in the portfolio, we don't think about it just exclusively in terms of the name of the issuer, but also in terms of the risk in the portfolio and exposures maybe to a sector or to a part of the curve. If I looked across the portfolio, one or two things I might highlight is that, we don't think at the moment that and we're, probably one of our bigger risk positions is we are underweight longer dated corporate credit. That's a function of our view on long-term credit spreads and specifically that, you're not really being compensated in your portfolio for lending money to companies or lending your capital to companies with very long maturity. And that's a good example of an active position that doesn't come out maybe as obviously the individual holders.
Are there any other questions? I see none. We'll thank our money managers from Leith Wheeler, and now we will turn over to our next presentation from Connor Clark, Lund Investment Management. I'd invite Joanne Bouchard, Portfolio Manager, Client Solutions, and Carolyn Kwan, Portfolio Manager and Product Specialist, to give their presentation.
Thank you very much, Mr. Chairman. My name is Joanne Bouchard. I'm a Portfolio Manager for Client Solutions with Connor Clark and Lund Investment Management. I have the pleasure of having my partner, Carolyn Kwan, who is a member of the macro team, product specialist, and also responsible for all institutional investment investors, should I say, with Connor Clark and Lund Investment Management. Today, we propose to give you a brief overview of any updates with respect to the firm itself. We'll review briefly also our responsible investing program, and Carolyn will address the committee with respect to the portfolios. So we now have 48 billion of assets under management, as you can see on page number 1. Please, Sylvia. As you can see on page number 1, we have 48 billion of assets under management, of which 14 billion are being managed by the fixed income team. We're still one of the largest independent money manager in the country. We're very proud of this independence. We now have 31 partners, 3 of which were just named earlier this year, that share in the success of the firm of our clients. At the board level, at CCNL Investment Management Board, we're pleased to welcome Michael Walsh. Michael is a managing director of Connor Clark and Lund Financial Group. He's replacing Mike Freud, who remains co-president of the financial group. David George, who's co-lead of our fixed income team, has also joined the board earlier this year. With respect to the team, we're still looking for one more person to join the management team on the macro side. As you can imagine, COVID has delayed somewhat our progress. However, as Carolyn will show you in a few moments, it has not impeded on performance. And we continue to add to resources as we just announced a search for a more junior person for our trading team. Any questions on the organization? So if no more questions, let me give you a few insights with respect to our ESG on page number 2. And obviously, when I refer to ESG, I refer to the environment, social, and governance issues. On page number 2, we present to you our overall program or thinking on responsible investing. As a reminder, the Connor Clark and Lund Investment Management Board is responsible for anything with respect to responsible investing. We've been a signatory since 2015, and at that time, the board.
Joanne, I'm sorry.
Yes?
I'm sorry to interrupt. I apologize. Can someone mute their phone? I'm having a very hard time hearing. Someone needs to mute. Thank you.
Okay. On 2015, we joined the UNPRI, at which time the board formed a special committee on ESG. Is the sound better? Okay. A special committee on ESG form of seasoned professionals for each one of our team within CCNL, including the client solutions and the compliance team. Their goal was really to coordinate and promote all the themes related to responsible investing. A lot of initiatives have taken place since 2015, and as you can see on the following page, on page number 3, this is our scorecard the most recent scorecard done by UNPRI, whereby you can see our score being above median or at median in all the different categories. On page number 4, I'm just going to talk a few moments on our thinking, our commitment, should I say, to improving the outcome through active ownership. I'll spend a little bit more time on integration because all our teams at CCNL integrate ESG in their analysis. On a fixed income side, it's a more systematic approach whereby ESG criteria will enter into the analysis of our spread forecast. And should there be an issue of materiality, it would be reflected in the forecast of the certain issuer. Obviously, engagement and collaboration is also key at the firm level and for the fixed income team. We belong to different associations such as the Canadian Coalition for Good Governance, Responsible Investing Association. And obviously, we talked about the voting here. However, voting for fixed income does not quite apply, but we have our own voting policy that gets implemented when asked to vote on a proxy voting. If there are no questions, maybe what I'll do is turn it on to my partner, Carolyn Kwan, who will provide more insights onto the portfolio.
That's great. Thank you very much, Joanne. As Joanne has taken the opportunity to review our firm and our approach to ESG and in our investment process, I'd like to spend a few minutes now on the bond market developments and what that has implied for the portfolio. We can move to the next page. You can see that throughout the year, we've had a significant decline in yields, and you can see that most clearly on the left side, where you have the yield curves of 4 different periods from December of last year, March in the gray. The December of last year is the blue line at the top, and the yields had declined, particularly at the shorter end of the curve. And they continue to decline into the second and third quarter with the yellow and green lines at the bottom, the 2 yield curves for June and September. And interestingly, they sit on top of each other, noting that really over the last few months, interest rates have been fairly steady. On the right side, this chart gives you an idea of the credit spreads over the last few years, actually. But again, what we saw in the early part of 2020 was a significant widening in spreads, followed by an environment where spreads narrowed quite materially. And that tightening move that we had was rapid and significant, and in response to the really aggressive actions that we had by central banks. The gray region there represents the third quarter, where spreads have on net tightened, but as with interest rates, they were not quite as volatile as they were earlier on in the year. They were on net tightening, but at a shallower pace. So overall, if we were to characterize the most recent few months, bond market volatility has in fact dampened since policymakers have intervened so forcefully to combat the economic and health crisis we find ourselves in. So let's turn to the next page to see how these moves have impacted the portfolio. The performance that you see here represents the first half of the year, so as of June 30th. In moving from the left to the right, in the second quarter, the bond index gained 5.87%, taking the year-to-date gain up 7.53%. The city's bond fund has outperformed by about 98 basis points for the second quarter, and that has more than recouped the first quarter underperformance, leaving year-to-date to June 30th to 68 basis points ahead of the benchmark. I'd like to update that now for you verbally to the third quarter. We've had the bond index appreciate an additional 0.5% or so, 44 basis points, and the fund outperformed by just over 20 basis points. So year to date, while the index has appreciated 8%, a significant gain that was helped by both the lower rates, but also tightening in spreads on net through the period since the volatility. The performance of the city's portfolio is 94 basis points above its benchmark. And what I'd like to do now is spend a minute on attribution, where the sources of added value arose. So each of the strategies that we employed accounted really for part of the contribution, which was in turn a result of the active decisions that we made through that volatile period. In a very broad sense, the sector allocation, so our overweight to corporate and provincial bonds was the biggest contributor. A good portion of the performance arose from the spread tightening that I showed you on the prior page. Interest rate strategies also accounted for a material contribution to the added value, specifically a longer than duration position, a steepening position in the yield curve, as well as a position in real return bonds. And then finally, security selection accounted for the balance, with overweights in higher quality corporate bonds that have companies that have very strong balance sheets. We continue to see ourselves move through this period where we've gone through an extraordinary recession, and as we move through this recovery, we certainly want to continue to emphasize those companies that have strong balance sheets and strong liquidity. I'd like to take a minute to give another verbal update, this time on the second of the two portfolios that we assist with managing. This is on the portfolio that holds a number of municipal holdings, somewhat less traded. We've noted that in the marketplace, there's been an appetite for higher yield by investors, particularly in this low interest rate environment that we find ourselves in. And coupled with supply, despite there being good supply, not keeping up with demand, our trading team has been able to take advantage of some opportunities to sell down that portfolio in the last 6 months or so. We have liquidated approximately $136 million so far. We did this in a measured fashion when we found favorable pricing, and the value of the remainder of the portfolio is approximately $100 million. I would like to take a moment now to turn to talk a little bit about our outlook, our macro outlook, and how we are positioning the portfolio going forward. So I think more so than in other times when we may meet with clients, it's not compulsory perhaps to review a situation that everyone pretty much worldwide is experiencing this year, the shutdown of the economies in an attempt to gain control over the spread of the pandemic. And as we progress through the year, the recovery through the third quarter has in fact come on the margin a little more quickly and forcefully than we perhaps had originally anticipated. We continue to make great strides together in reopening the economies. And as we have done so, the economic activity has picked up quite significantly. However, as we move through the next few months and quarters, the next steps will become a little more incremental in nature and more difficult. In order to support this healthy rebound, in order for that to continue, governments do need to continue to extend their extensive policy measures that we've had. Fiscal policy is becoming critical, and in relation to that, debt has certainly built up materially, but certainly is required or necessary to help bridge that gap for households and businesses. Monetary policy, if anything, is somewhat in a supporting role. The chairman of the U.S. Federal Reserve said as much yesterday in a message about the urgency of the need to spend to maintain the gap going forward, allow companies and businesses to support their way through the rest of this year. The markets have been supported by this massive policy response, and so we continue to look favorably to that. And so I'll review the positioning in the next step. But before I do that, a number of risks that we're watching. Certainly, the biggest one as we head into the fourth quarter is political in nature. It's obviously going to be very topical and a market event, either from an outcome that may be uncertain or the resulting overall policy stance. But in addition to that, of course, the health crisis remains paramount. As we move into especially this winter season, it's typically, the winter cold and flu season. Nevertheless, we do believe with all of the knowledge gained by scientists and doctors, as well as what we've learned through social interactions to mitigate the spread, we should be able to manage only with targeted shutdowns rather than the widespread ones we had earlier in the year, allowing the economies to continue to reopen in fits and starts. So given that macro backdrop, how are we positioning the portfolio? Through the early part of this year, we had been active in taking positions on in response to the extraordinary volatility that we had. And certainly as we move through the rest of this year, we maintain a duration position that is longer than the benchmark. We have a yield curve position that will benefit if the yield curve steepens. And we don't expect longer-term interest rates to rise materially, nor do we expect negative interest rates. However, it is likely that we will see policymakers not necessarily unhappy with a little bit of a steepness in the yield curve more than we have today. and we have a considerable amount of fiscal stimulus that is expected to become forthcoming, and so we would expect some modest upward pressure there. And then in our credit positionings, we have an overweight position right now in our corporate bonds. Again, within our security selection, adding risk on the margin, but overweight those companies with very strong balance sheets who are going to prosper still in this recovery period. We have overweight in utility companies, in communications companies, and banks. And then finally, we will hold a real return bond position. It's an overweight position, a weight that we want to, bonds that we do want to hold for now. It is a good hedge, we believe, for a possibility of inflation in the medium term. In fact, over the last few months, as we have seen inflation expectations normalize from a very precipitous drop in March, these have, in fact, contributed to the performance of the portfolio. That concludes the remarks that I'd like to make today. Very happy to, Joanne and I would be very happy to take questions.
Thank you, Joanne. Carolyn, we'll open the floor up to questions as soon as my screen comes up. Colin, you got your hand up. Go ahead.
Well, thank you. Just a very good presentation. Appreciate it. Just one quick question back to slide 4 on the ESG point. Wondering whether you're able to just provide a quick example to contextualize some of the points that you've made on that slide.
Absolutely. If you look at one example, I'll use an example of integration. Dakota Access Pipelines, as many of you may or may not know, it's a company that does that distributes is a pipeline company that goes from North Dakota and brings the oil to a terminal in Illinois. Enbridge owned about 27% of the company, and while it does not have a large impact on overall Enbridge, because it probably has a 2% impact on the EBITDA, the fact that there was controversy with respect to the possibility of an oil spill and the possibility, then there's also an impact on Aboriginal rights. It would be affecting some of the land that is considered secret. So we we integrated that information as part of our Enbridge analysis and actually widened the spread, which resulted in a decrease in the overall Enbridge exposure.
Thank you.
Thank you. Any other questions? Oh, Heather, I see you. Go ahead.
Thank you. So thank you very much for the presentation. You made a comment in your presentation that you don't expect negative interest rates. Obviously there's lots of discussion about that right now. Can you just expand on why you're making that statement?
Yes. So in the experience of the sort of world central banks, we've had negative interest rates in a number of the central banks around Europe, and they have resulted in interest rates falling negative further out the term, and caused a number of difficulties around the issues with household savings, with the banking sector. They have been, the purpose of negative interest rates is to try to push out some savings into the real economy. In reality, what has happened empirically, really, is that households have actually had to raise their savings rates in order to combat the fact that in the future, the availability of sort of low-risk income to come to them has actually diminished. It has actually had a perversely negative effect on economic activity. These things are still up for study now, but for listening to policymakers in North America, it is likely that they have actually stated that they do not believe negative interest rates are a policy tool that they want to engage in the near term, that they believe that there are other tools within their toolkit, things like forward guidance, potentially things like yield curve control, managing interest rates, not just at the overnight term, but moving further down the term of the yield curve, perhaps to 3-year yields, or as they've done in the Reserve Bank of Australia, or to 5-year yields, which are the interest rate that matter most to Canadian homeowners. These types of tools for central banks, they believe, are more likely to result in a pickup in economic activity, a way to support economic growth better than negative interest rates. So it's unlikely that they want to take policy rates negative, which would alleviate the strain further down the curve.
Thank you. Any other questions? Seeing none. Are there any questions of the staff on this item? Anyone who wants to say anything? Could I have a motion to receive the presentation? Somebody want to? Mary has made the motion. All in favor, please raise your hands. Opposed? The motion is carried. Thank you. Thanks to all that group. Now we'll move to item number IB 9.2, Sinking Fund, Long-Term Fund Performance Compliance Update for the second quarter. We have a staff report on this item, and I'll turn it over to Randy Leclerc, Director, Capital Markets, to provide an overview of this item to the board. I think also, Randy, do we have the Aon folks on also?
Yeah, I believe they should be on.
Yeah, so we'll also...
Yes,
I guess
we're here.
On the channels, I think, is Brian White, partner, Nick DeLisi, who you've met before, Kirlos Gurgaz, if I've murdered his name, partner, and Raghav Wadha, senior analyst, and I may have murdered his name, so I apologize. Over to you, Randy.
Thank you, Mr. Chair, and I'll start. It's a long report, about 12 pages, covering the second quarter. It deals with performance and compliance to the investment policy. I'll deal with the compliance piece first because it's all on attachment 3. We actually, through our custodian, do a review each month, a detailed review of compliance to the investment policy. We also do a daily one, but what you have in attachment 3 are compliance to those. You'll see all green check marks for the second quarter. In addition, we also receive compliance reports from the 4 fixed income managers that we have investment management agreements with, and you'll see that those are there as well, confirming compliance to the investment policy. As far as performance goes, I'll deal with just a few points here that we talk about, and we've talked about in the past, which is earned income and what our budgeted numbers are to support the city's operating budget, and then I'll turn it over to Aon to talk about total return of each of the managers, as well as the overall return of each of the sinking fund and the long-term fund. Just flipping through the pages, table 1 kind of gives you sort of the size of the growth of the portfolio, where we were, where we've been as far as the sinking fund goes. Keep in mind, last year we had $400 million go out for a maturity. Nothing in 2020, but we do have a large payment in 2021, which is $650 million. So you'll see that one fluctuate. Some of the other tables that are in there are breakdowns of the portfolio. Table 4 and 5 are from the Aon report, just sort of some highlights. I'll let Brian or someone from Aon deal with that, as well as table 6. And then table 7 shows you the earnings that we are earning from the sinking fund, and we're pretty much on track there as well, dropping down slightly just because, again, of the fluctuations in the portfolio, but we're generally in line. We have the same for the long-term fund, and I won't go through all the details there, but again, table 8 shows, if you look at the June 30th number over to the far right, the total invested is just over $3 billion. Table 9 and 10, more of a breakdown, and then some of the highlights from the Aon report. What I would, on the page 11, is the earned income requirement update section, which is probably key for the city as far as the operating budget goes. And table 15 will show you that the required income for 2020 is $143 million. So far in Q1 and Q2, the actual earned income, which would be interest, dividends, and actual capital gains realized is at 74.4. So we're on track over at the halfway mark as of June 30th with another 68.6 million to go. We're in pretty good shape there. At that point, I'll turn over the only other small item I wanted to mention was the flow of funds report. We usually do this first thing in the year, is attachment 4, and it just shows you the sinking funds and the contributions to the sinking funds through the year. Because of the COVID situation, it was missed, and we thought we would include it here. I'll talk a little bit more about the sinking funds and rebalancing them when we get to the investment manager update. At this point, Mr. Chair, I'll hand it over to Aon, Brian, or one of his partners.
Perfect. Thank you. I'm assuming everybody can hear me. I'll take that as a yes. I'm getting a little feedback here. Maybe if people can mute their microphone. Okay, well, we'll just plow ahead. So in Exhibit 1, which is dealing with the Toronto Investments Board discussion guide, if that could be put up as a presentation. There we go.
Hi, Brian. This is Manesh from the City Clerk's office. Sorry to interrupt. Do you have multiple headsets or speakers connected right now?
I do not.
Through you, Mr. Chair. Okay, I was going to ask if clerks could mute everybody that aren't speaking.
There we go. Okay, so thank you. So the discussion guide, we're looking on page 3, and this is really an economic overview. We've had a couple of economic overviews so far, so I'm actually just going to break it down to specific themes. So we've had a lot of things go on in the marketplace, and I think the number one theme that we have to understand and expect is volatility in the near future. Theme 1, we've had strong economic data that's really come out of the balance of the year following basically what we saw mid-March and how the market declined. We heard that from both Connor Clark and Lund and from Leith Wheeler that this is really very much being driven by the central banks and their ability to support the economies, and that is fundamental on a go-forward basis that continues to happen. One thing that we've been hearing a lot of late, within the last week or so, even more than a week, is basically the deadlock on the U.S. stimulus that we've been hearing about, and so this is something that we're going to continue to hear about in the U.S. This is going to continue to cause volatility. We're also hearing investment managers start to talk a little bit about the concept of inflation. And the relevance of that is that at some point in the future, you basically have to pay the piper. So the fact that we're seeing central banks of the world support the economy, this is at a cost. And invariably, this could ultimately turn into inflation. Although the general sense is that we're not going to see any inflation for the next 2 years. That's the good news. The bad news is we're not sure what's going to happen at after the 2-year period. Second is U.S. president election, which is coming up. And of course, that's going to affect the first one as well. The first point that I made with respect to the central banks. But ultimately, this is going to cause a lot of volatility. We've also seen on the political front noise, such as the replacement of Ruth Bader Ginsburg. Of course, the Republicans have put forth a suggested replacement, and that's created some controversy. And so we're going to continue to hear noise as a result of that. Trade tension, the U.S. and China. That's going to, and interestingly enough, that was kind of the number one point I think that we probably discussed when we were in person last time. which was pre-March. But anyway, things have changed. That being said, it continues to be an issue. And so currently the big debate is about China and the U.S. Most recently, the U.S. has imposed sanctions on China's biggest chip maker. And so this is a battle that's going to continue. And how it's addressed will, again, depend on the outcome of the presidential election. We're seeing Brexit, the deadlock continues with Brexit. And so that's just going to continue to create noise. At the end of the day, they'll come to a resolution. But right now, the UK has proposed basically a bill that basically changes the nature of the agreement ultimately that they formed in terms of Brexit, and ultimately that's going to be a debate. The number one thing, though, is COVID, and I think we've heard that from both the investment managers. Vaccine trials are not going as well as we had hoped. We've had some pauses in those. We've seen some resurgence of cases. We've seen different types of restrictions come through in Europe. And bottom line, COVID is the underlying reason why the economy has been suffering, even though we've seen glimmers of hope. And until the disease is basically held at bay, it will continue to cause volatility in the marketplace and affect our productivity. So let me just talk briefly about market returns. And so what we've seen on page 3, we can see the different market returns with the S&P TSX over the second quarter performing quite strongly at 17.0%, and the S&P 500 in Canadian dollar terms coming in at 15.3. These are very strong numbers for the quarter. Year to date, we've seen some pretty reasonable numbers given what we've seen in the marketplace. But that being said, things will continue to be volatile and move around. I do have some performance numbers for the period ending September. And in essence, I'll just verbalize them because I can't project them. In essence, what we've seen is the Canadian equity market underperform year to date with a negative 3.1%. The U.S. equity market in local dollar terms, so in U.S. dollar terms, has a positive 5.6% return. And the world market has come in local currency returns, a positive return at 1.6%. Canadian currency has added to the return for those that have had to be converted back into Canadian dollars. So it's increased the year-to-date return. And an underlying theme is that we're seeing value stocks dramatically underperform growth stocks, which is actually something that we've been seeing for the past 11 years, I'll say. So by example, the MSCI Canadian Growth Index for year to date came in at 14.3%, and the value index came in at negative 21.5%. So quite a divergence between the growth and value stocks in Canada. On a global spectrum, in local currency terms, so removing the currency effect, converting back to Canadian dollars, we've seen the growth come in at 18.2%, positive 18.2%, with the value index has come in at negative 14.1%. So again, very strong divergence. And so those are year-to-date numbers. I should pause. Any questions on the market overview? So why don't we plow ahead into page 3? Perfect. And so what we have here is an executive summary of the sinking fund returns. What we've seen is that the sinking fund has come in at 9.5% over the quarter, which is an outperformance relative to the benchmark of 1.2%. And the long-term funds came in at 7.5%, which was an outperformance relative to the benchmark of 0.4% or 40 basis points. You can see the market values on this chart, with the sinking fund being about $1.2 billion, I should say, and the long-term fund being about $2.5 billion. The estimated fees that are being paid by the fund. And we do not recommend any action for these two funds. We think things are going well at this point. We can flip to the next page. This is an asset mix for the sinking fund. And what you can see here is that the green is showing what the target allocation is, and the blue is showing what the actual allocation. The message I would convey here is that everything is in check, given that we are still in transition mode, and the explanation for the difference between the target and the actual allocation is one, we have not completely funded the global equity mandate, and that is, I think, a topic for discussion later on, but that's very close to being finalized, which is positive news. The second is that there's an allocation given to real estate, and that's a subject that we still need to talk about. I think it's on the agenda to talk about today as well. And so while that money is not being allocated to those funds, it is currently being held in the fixed income component. If we can flip to page 6. Same story here for the long-term fund. And really, I have nothing to add other than it's virtually the same story. And if we can flip to page 7. This particular chart shows the performance and the ratings of the various underlying managers. And what you can see here is that virtually all the managers are buy rated. I will actually point out the second from the bottom, we have Oakmark Global Equity. You may recall that was Harris, and the name has changed. It has since been acquired by Fiera as well. So it's a completely different fund, though. And so what we have is buy ratings for all the funds. We can see the value added for the various components, and all funds have shown value added on the quarter, except for Pier 21 and Fiera. And both of these are still strong conviction managers for Aon. They're fairly concentrated, but just over the quarter, their particular holdings were not valued by the marketplace, so there was an underperformance. The since inception number, which you'll see under that's SI under the value added, I would take that with a grain of salt, because there's been a lot of, it's a very short period that we've had in terms of performance, and the front end of that period, there was a lot of noise with respect to the transition and bringing it online. So that particular number is a little bit problematic. We have columns here, objectives and the median, action required. This sort of information is really, it's a little bit early to discuss this, given that the mandates are so new. So unless there's specific questions, I will flip to the next page. With respect to the manager updates, there's no significant manager updates. What we've seen is on the Fiera side of the equation, there's been some changes within the organization. I have to say, quite honestly, Fiera, just by their nature, is an organization that tends to change. They have a growth mandate. There have been acquisitions, hence Oakmark, or Harris and Oakmark. They have recently made some announcements with respect to changes within the LDI, which is liability-driven investment, or fixed income team, specialty fixed income team. And this is really to be expected with Fiera. None of the announcements that they have made have been something that we have considered to be a negative with respect to the Toronto Investment Board's mandates. And I think that's the majority of what I was going to discuss. I'm happy to go into the second attachment, which is the more detailed performance, if people wish to, or we can pause here and just ask if there's any questions.
Why don't we open it up to questions at this point? And Colin has got his hand up first, so go ahead.
Yes.
Well, thank you, Brian. This question is more, perhaps we'll use slide 11 in the appendix for this question. Just building on your comments on value versus growth, the underperformance of value today, both in Canada and the US. Just curious on your thoughts going forward. As we come, perhaps out of the health crisis, we have a, return to normal for the next year or two. What's your thoughts on the relative attractiveness of value versus growth?
Well, I think it's very attractive, quite frankly. I think there's a real argument for a contrarian approach right now, given what's going on in the marketplace. The underlying fundamentals of stocks that are driving, I'll pick on the Canadian marketplace, for example. Stocks that are driving the Canadian marketplace. And the reason I pick on the Canadian marketplace is it's very concentrated, and a couple of stocks can be really, really impactful in terms of the outperformance or underperformance. And so what you'll find in the Canadian marketplace is you have stocks that just don't fundamentally justify the continued growth within the portfolio, but there's just a momentum in the marketplace for these types of stocks. That does not mean that the underpriced, underappreciated, I guess underpriced is the wrong word, undervalued, underappreciated stocks that are plunking along in the economy and continuing to create units of productivity aren't worth more than what they're being valued at. And that's really what we hope to capitalize on. Interestingly enough, for the vast majority of my career, value has really been the predominant style. And we've now hit, since subprime, a real change of the market, and so growth has really had its day in the sunshine over the past 11 years. But I think that things will come back, and that we will see the value stocks continue to increase.
Thank you.
Okay.
Do we have any other questions? Looking for any hands? Seeing none, I guess we'll. Any questions of the staff or any speakers on this item right now? Well, could I have a motion then to adopt it? Could somebody raise their hand? Sharon, it's your turn. Sharon Branson, all those in favor, please raise your hands. Opposed? The motion is carried. Third item on the agenda is IB 9.3 Investment Manager Update. We have a staff report item on this, and I'll turn it over to Randy Leclerc, Director of Capital Markets, to give an overview on this item. Go ahead, Randy.
Thank you, Mr. Chair. This is another report for information. Several parts to this one. We want to just update the board on the negotiations with the final global equity manager. Second, we want to talk about the rebalancing of the sinking fund. There was nothing for the long-term fund, but what happened with the sinking fund. And I believe that's about it. Oh, right. And that's about it for this report. So we have, as far as the negotiations go, it's been going along quite well. A little bit slower, I guess, probably due to COVID. And but this week we received the sort of the final piece, which is the application to fill out. We were actually hoping to have it here today for the chair to sign, but there were still a couple little parts that were missing, and so it'll probably get done in the next week or two, and then we will fund that final manager. So I did want to point out, though, in the attachment here to this piece, just to kind of add on what Aon was just saying, their investment returns only include those assets already invested and does not include the cash available to go into these funds. So if you go to attachment 1, it shows you the current funding status of both the long-term and the sinking fund, and you can see the weights are quite a bit different than where we were or what perhaps Brian had shown in his, because he's not privy to the cash that we're holding on the side here, and it is kept separately for both funds and not commingled with the city funds. So if you take your eyes down to the bottom of, or near the bottom of the first table, you can see that about 19.4%, or $735 million, is being held on the side. About 20%, 10% that will go to this final global equity manager, and 10% that will be set aside for real assets. Similarly, over with the sinking fund, which is the other table just below it, again, if you look at what we're keeping on the side, there's about 21.6% of the fund is being held in cash. That's the equivalent of 433.6 million. Combined, it comes to $1.169 billion that we're currently holding in short-term funds. But as I mentioned, hopefully within the next couple of weeks, the paperwork will be finished, and the funding will start with the final global equity mandate, which will be about $580 million combined for both the long-term fund and the sinking fund, leaving about a similar amount for the real assets. And so that's where we're at with the, as far as the final global equity manager negotiations. The only other item here I wanted to point out, which was towards the end of the report, the rebalancing of the long-term and sinking fund. We were building up excess cash beyond that 20% in the sinking fund, and it comes back to this flow of funds. We had conversations with both of the fixed income managers, because that's where the underweight position was, given that we had just recently funded the three equity managers, which are all 3.3%, those first three global equity managers. So with that, and to bring up the fixed income in line with the weightings that you saw on that table at the end, or the attachment at the end, we used $311 million, split slightly differently between Addenda and Fiera on their mandates. And the reason why they're a bit different was you may recall, when we first funded them, we did it with actual securities that we're already holding, and there was a bit of a difference between the two. They agreed to split the portfolio, and it didn't make sense that, especially on some other holdings, that they would have a small holding and split that in half. So there was a little bit unevenness there, which we evened it up with this cash. And that was done, trade date September 3rd, and settlement date September 8th. There might be one more rebalancing before the end of the year. There's a chunk of about 50 million or so that will be able to be sent over to the managers at that point in time to, again, rebalance and bring everything back in line. And that's it from me, Mr. Chair.
Thanks, Randy. Are there any questions for Randy? Seeing none. Anybody wants to speak on this item at all? No? Okay. One of the assignments given to the committee originally by City Council was to look at the custodial arrangements. I guess we are currently meshed in with the overall custodial arrangements of the city, and my sense was the direction from Council was that we should have our own custodial arrangements, and maybe I would ask Randy, and frankly I think we've been going a little slow on this as we brought in all these on managers. We're trying to understand what the volume of trading was, et cetera, et cetera, et cetera, so we could have a good picture in terms of the cost structure and what people should be quoting on. So maybe I would take a moment just to ask Randy as to the status of that.
Yes, Mr. Chair. Actually, the last time we reported on it was back in April of last year, 2019. And at that time, we mentioned that we would like to see all the managers come on, and because anybody bidding on the business is going to want to know volumes, that type of thing. And so at that time, we informed the board that we would like to wait until we get all the managers on. We thought, we would have had the all the fixed income and global equity managers completed by early 2020, but of course here we are late in 2020, so we really haven't progressed anything further than that. I have had conversations with our current custodian, which is Royal Bank, ITS, as well as I know there's a few other municipal governments that have been looking at this, so happy to report back and give you an update on this. There's also, I'm not sure of how the city's contract is with our bankers. The city's main banker is also the Royal Bank, and I know there's an umbrella agreement, so I'm not sure exactly if there's this can be untangled or how that works exactly, but we'll have to do some work before we get to to give you a good answer on where we're at with the custodian.
Thanks, Randy. Any questions of Randy on this item? If not, could I make a motion that the Toronto Investment Board request that the Director, Capital Markets, to review the custodial agreement and report back with an update at the next next meeting of the Toronto Investment Board? Do I need a second?
Mr. Chair?
Sorry?
Do you mind if we actually just discuss the motion rather than voting on it right away? Would that be acceptable?
Certainly. Go ahead.
I just want to point out probably something that's quite obvious, but the team that supports this board, has been heavily involved in managing the cash and the investments for the city and managing through the pandemic. I will say that I am cautious about jumping into something that will create some work, probably from my perspective, a little bit prematurely. As you know, Randy just mentioned that not all managers are actually on board as of yet. We've only got data for about a year, and I don't know whether or not a review at this point in time would be as prudent and as productive as it would be if we waited. So I'm just a little bit reluctant. I think it's a bit early to have the staff look into this. I worry a little bit about, we are in a pandemic. The pressure on our capital markets team is quite substantial right now, and adding this to the mix at a time when I think it's premature is something that I just want to flag for the rest of the members is a significant concern that I have.
Thanks, Heather. You made some good points. What I was trying to do here is just to get it on the record. Could we make an amendment to the motion by removing the words "at the next meeting" and just say, it's on the record that the staff should be looking at this, and obviously cognizant of the work issues, the COVID, et cetera, but we, from a record keeping track of our jobs, it's on the record, and we'll leave it to you and Randy as to when it's appropriate to bring forward. This way, we've got it in the job jar, and we'll deal with it whenever we can. Is that satisfactory?
Thank you, Mr. Chair. I agree.
Any other comments or thoughts? Could I, with that amendment, removing the words "at the next meeting" to the motion, all those in favor? Opposed? Motion's carried. Thank you. We'll now move to item IB 9.4, Real Assets Update. We have a staff report here. I'll turn it over to Randy Leclerc to give an update here. We've also have a cast of thousands from Aon who will be supporting this discussion. Randy?
Thank you, Mr. Chair. This is another for information report. As the board may recall, that at the last meeting, I think it was a general consensus, although I don't think we had any motions on it, that the board wanted to be updated on this asset class going forward. It was a very cautious approach, and so Aon is. I'm just going to turn it over to Aon to give an update as to what's going on with real assets at the present time.
Are you there, Brian?
I am. Thank you. Carlos, are you on the line?
I am.
Excellent. So I'm going to turn it over. So the discussion specifically was about real estate. And so I'm just going to turn it over to Carlos, who is the subject matter expert that we've had come in and speak to the committee in the past. So Carlos, the floor is yours.
Thank you. So we've included a real estate. It's only 2 slides, and I'm happy to kind of walk through it at a high level and then answer any questions that may be out there. But maybe we'll start with slide 2 of that slide. And there's a little bit of background noise. If someone can mute their line. Thanks.
So we moved the motion, so the item was amended, so we need to go back to that.
All right, thank you. So
Committee room 2 that needs to move.
I thought I did.
Okay.
I'll try to speak loudly. So, in terms of what we're looking at on slide 2 of this deck is we'll start with our overall investment themes and what we're looking at and how we're approaching the world today. And last we spoke, we talked a little bit about global open-end funds and getting an allocation to the global real estate market through these open-end funds. And now what we've essentially said is we're going to not invest in legacy assets because of the valuation issues that we're seeing across the market space. Transactions have slowed down quite a bit in real estate. I think they're starting to pick up now in certain sectors. We're starting to see specifically multifamily and industrial deals get done. But overall, transactions have been slower than they have been. And because the transaction space has slowed down a little bit, most owners of assets who are well capitalized are unwilling to provide a COVID discount, so to speak, and so they're holding on to their assets. There's a wide disparity over what bids and asks are for certain assets, and so what we've done is we said we're going to hold off on investing in anything that's got a legacy component to it, or assets that already exist, because those assets will likely be impacted by COVID. And we saw that in the U.S. in the second quarter. The NFI Odyssey, which is our benchmark, was down negative 1.75% return. That was net, and the PFI in Canada was down negative 3+ on a net return basis. So we saw that those assets are being affected. In the U.S., we're expecting probably a flat return this quarter, to slightly negative. So we're still monitoring the Canadian managers, trying to get whisper numbers and things, but for the most part, those assets have been impacted because of the valuation issues, because of the cash flow situation within those assets, specifically in retail, and we'll get to the sector-specific stories in a second. Our preference right now is blind pool investing, and so finding managers that have dry powder that is going to get put to work here over the short term in order to take advantage of the dislocation. A lot of what we're looking at are opportunistic type managers who are providing either a broad investment strategy or some kind of emerging investment strategy, or are looking to access real estate via the private debt space. There's a number of different opportunistic strategies that are out there today that we're looking at because of the market dislocation. And again, our preference is managers who started investing post-COVID until with dry powder to put to work in order to take advantage of that opportunity set that exists. Where we see some positivity is in the industrial and data center space. Data centers, because of the consumption, I mean, we're all on a web call right now, WebEx, and people have been using Zoom and other types of video mediums, and self-driving cars like Tesla continue to roll off the line, and so there's more and more data consumption. So data centers have become an important part of a number of investment strategies. Industrial as well, because of the Amazon effect and Walmart and others who are looking to same day, 2-day, 1-day delivery type strategies are looking at more and more industrial. So from a public perspective, those REITs that focus on those sectors have done a little bit better than others. Where there's a little bit of uncertainty, and again, we'll get into a little bit more detail on the next slide, is office. That's probably the biggest question mark given the COVID impact on working from home. Single family housing and apartments, we've seen that apartments continue to be defensive, some softening in some areas, but mostly still defensive. Rental collection in apartments has still been in the 90% plus from the assets that we've observed. And so still defensive. The reason why uncertainty exists there is because stimulus packages are starting to roll off. And so, Trump yesterday said he's going to end stimulus packages until after the election. In Canada, I think the stimulus package is actually going to end this month, with more stimulus packages ending at the end of the year. So there's going to be some softening maybe in those areas, but we continue to monitor the apartment space. But that's why there's a little uncertainty there. And then the negatively impacted sectors are retail and lodging mostly, and then some senior housing due to some negative press early on with a number of the senior housing that cohort exhibiting some outsized susceptibility to COVID. So if we go to the next slide, we're going to go sector by sector, and I know the committee is short on time, so I'll try to keep my comments high level to the extent possible. But the office sector, already started talking about it. We've noticed that there's this big shift, and hoteling reduces space need by 35 to 45%. And so if most owners of these assets and most companies that lease these space, as they tell their workforce to start working from home, and we've seen big stories about that in terms of Google and Facebook and Twitter and other tech companies that have essentially told their clients they can work their workers that they can work from home indefinitely. That's going to have some kind of impact over the office space. I will say it's an asset by asset story here more than the other sectors, in that we're still seeing opportunities in the life science space, the lab spaces, where you can't really work from home from that perspective. You have to go into the lab and conduct your experiments or do whatever you need to do from that perspective. So there's that story. The suburban office story is another interesting story, in that these locations, they're usually larger floor plates. They're usually compounds. They have more space. They're close to people's homes, so people might feel a little bit more comfortable. So there's this kind of semi-emergence of the suburban office space, although we're still analyzing that trend and seeing if it's going to be a long-term trend or some kind of short-term story. There are going to be companies that want their workforce in the spaces in which they lease, and so again, it's going to be an asset by asset type story. But for the most part, we're still pretty uncertain here. Most of us are still working from home. A lot of us are going to continue working from home through the new year. More and more companies get to look at the impact that has on their bottom line as they do their analysis. And there could be some kind of hybrid situation where less space is needed, where workers come in twice a week or 3 times a week or whatever the case is, where you're trying to stagger people back and forth and maybe take up less space over time. Right now, the leases are contractual. So any one of these assets that has long-term leases, those long-term leases are contractual. It's more the assets that have some short-term lease rollover that might be most susceptible. But again, still an emerging type of situation, a situation that we're analyzing over time, and I think is going to be a longer-term story than other sectors. Apartment, again, more defensive, good rental collection in the apartment space. Not a lot of movement in the cap rate situation there. People are staying in their apartments. Not a lot of people have moved. There's a lot of uncertainty about their current situation, so not a lot of movement there. Where we have seen some movement are the older millennials who were occupying these spaces, who are now starting families, and they're looking to that single family rental space in order to get that space that they need. So instead of paying $2,400 for an urban downtown type of asset that's 600, 700 square feet, they're going to look for something that's a little bit larger, that has a yard that they're paying some similar amount for in the suburbs around where they want to be. Again, the work from home situation affects that a bit, in that they've got more flexibility in where they can be, and so they may not need to be in those urban nodes where they need to work and live. Again, the stimulus packages might affect the sector over the next several quarters. We're to keep watching that situation, but I will say that that's likely going to affect more of the B plus type of apartment assets. Most of the luxury, or let's not call them luxury, but most of the A type of assets, that workforce hasn't been as impacted as the B plus workforce. So again, just a bifurcated story, and we'll continue to watch that. But as the stimulus package continues to roll down, we'll see what comes of the apartment space. We are seeing some increase in unemployment as well, and so that may have some impact on apartments. Industrial, we already touched on it a little bit. The Amazon effect has been strong in industrial. Others are trying to keep up. The story with COVID and how it's impacting industrial is actually being overly packed right now. And what I mean is they're holding more product, getting ready for a backlog of deliveries and things of that nature. So we haven't noticed a lot of cap rate movement in industrial. I will say that the smaller industrial assets in the space have been impacted a little bit more. Those who are catering to small businesses may have been impacted by COVID, but even those spaces are looking for lease up and should be able to weather the storm a little bit better than other sectors. E-commerce has been a huge driver of industrial. And on that same note, e-commerce has been a huge destroyer of retail. And so retail has been impacted by e-commerce. It was a situation that had taken effect before COVID even came, and COVID just kind of exacerbated the issue a little bit, forcing people to stay home, forcing more and more people to order online. People are getting more and more comfortable with that fact. Even the cohort that was very comfortable with going to the local mall, they are now looking for ways to get the stuff they need in short order from Amazon and from Walmart and from other e-commerce providers. The retail story is a complicated one. Again, the malls have been the most susceptible. Those big box type of mall areas, even indoor and outdoor malls have been impacted. In the public space, at least in the US, we've seen declines of 50% and more in the retail REITs. In the private space, we've only really seen write-downs of up to 20%. So there's a major disconnect there. So we ask ourselves again, do we want to start investing in legacy assets where there could be further write-downs in the retail space right now? Let's just continue to monitor that space. And when it's hard to be a market timer, and in the case of core specifically, more of a long-term investment for your portfolio. But we feel like this is not the execution point for that, and it's issues like this with retail specifically continue to take write-downs, and other sectors kind of showing a little bit of softness. That we'll take a little bit of a break on legacy assets. We'll focus on dry powder. We'll focus on blind pools. We'll focus on managers that are executing in different ways to take advantage, and then revisit core towards the end of the year or early next year. So I'm going to stop there, and happy to answer any questions that you may have.
Thank you. We'll open the floor up for any questions, and when my screen comes up and tells me whether would ask anybody to raise their hand if they have any questions. Do we have any? Start off with Heather. Go ahead.
So thank you for this. Obviously, we're all watching real estate quite carefully, given Toronto has been a hotbed for real estate. Have you been watching REITs and how they're performing through all of this? Obviously, a bit of a different perspective on real estate, but just curious on whether or not you have any perspectives on how REITs are performing.
Specifically on the U.S. side, we've been watching the REIT space really closely, and the public market was really quick to rebound. So where we thought there was going to be a lot of good opportunities early on, it rebounded quite a bit. It's not fully there yet from peak. It was still kind of off peak, and a lot of that is due to the retail REITs and the lodging REITs. So one sector we didn't really talk about is hotels, and hotels have been majorly impacted by COVID as well. And those hotels that were really thriving on business travel, those hotels have a longer story to tell. I think those hotels that were impacted by tourism, they will likely come back a little bit faster. But we are watching the REIT space. I will say that from peak, we're down probably 20% in the US. I'm sorry, it's a single digit number now. So single digits from peak on the US REITs. And last week was actually a pretty strong week for the REITs. They were up, I think it was 5.5% for the all REITs. And even the lodging and some of the retail REITs were up. And it's really, the story is that a lot of the negative impacts of retail hotel are baked into the overall story. And so the public markets have moved a little bit faster. And so we're still waiting to see what's going to happen in the private market space.
Thank you. Any other questions? Let me see. Why? Fortunately, our new member has a real estate background, so we'll ask Colin to ask a question then. Go ahead.
Yeah, it's a question versus comments, but I have to provide comments as well. But my question would be just on the industrial space, what's your view on pricing? Because pricing, from my perspective, has moved, and it's moved in, and cap rates have declined. So just curious on your views on that supply and how that responds as well to demand.
Yeah, I agree with you. Pricing has, the deals that I've seen most recently, at least with some of the managers that we work with, the cap rates are, the low fours still. I think there's the one-off high three probably cap rate deal that's getting done. And again, a lot of that's driven by groups like Amazon and others who are taking up more and more industrial space. I mean, there's a lot more managers right now focused on constructing industrial rather than going out there and buying it because the pricing is so tight. And so there's going to be more supply because people are looking for ways to construct it. Even that's proving to be a challenge. There's a lot of groups out there vying for the right property, the right land in order to build an industrial site. So more and more of these industrial assets should start to come up. Pricing has definitely come in, and there hasn't been a lot of price movement at all the other way, right? I think the small bay guys, the guys who are really catering to small business, I've seen some cap rate expansion there, but not by much, right? Because they're expecting to lease up those assets, those spaces, and so. I think that we're observing pretty much low fours in terms of cap rates and not a lot of movement in a negative way.
Thank you. Maybe I could just raise the question that I did at the last meeting. We've been looking at this asset class for, I guess, a year or so. The only concern initially was a little bit on the e-commerce impact on retail. Since then, situation was just discussed as affecting almost everything except maybe the logistics area. If anything, it seems like it's getting worse. We're starting to see write-downs. I think Her Majesty with the Crown Estate in the UK wrote her assets down 17%. Discussions of 20%. So I guess it raises questions as to whether we want to go into this asset class and take hits right now. And then the blind pool approach, I guess, could either turn out to be a big win or the opposite of a big win. So I'd like the views of the committee and your thinking as to, we've got a couple $100 million here that we're holding. We've been holding for a long time. It looks like there is potentially a fundamental change in this asset class. So should we just stay on the sidelines as this plays out in the weeks and months and maybe even years to come, or should we be looking for another home for that $500 million? I'd certainly love to hear from the group. Colin.
Yeah, certainly. I'll opine only because I had the benefit of a pre-meeting yesterday. So, It's not completely spontaneous. And the benefit of that pre-meeting provided me with a sense of how long it actually takes to work through the process to get things sort of done and contracted, etc. So I would say a couple, 2 or 3 points. Number one is I broadly actually agree with Carlos, and hopefully I pronounced it correctly. Yes, okay. I agree with Carlos's assessment here by and large. My caution is on trying to time the market, because my perception is we're in an environment right now where some points are very, very salient, like work from home. And I think that's an underlying trend that will happen for the long term, but certainly not at anywhere close to the levels we're at right now. Put differently, people will go back to the office, not everybody, but most people will. And what the proportion is, I don't know. but I think right now, certain property types look a lot more challenging than they will end up being as we come out of the economic situation we're in. I'd say retail overall is the asterisk to that, because I think that there is some significant legitimate challenges for some aspects of retail. Why do I say all of that? And if I connect the 2 points, so one is the timing, and number two is the moment we're in. The reality is, from what I understood yesterday, it will take quite a while to actually go through a process, and then and another while to sort of negotiate different points that are specific to the city, and another while to sort of join a queue and then get fully invested. So by the time all of that happens, my heavy hunch is that we will be through, call it a good amount of the health consequences of the pandemic, and we will be into an economic recovery. Meaning, from if we're October 2020 today, the reality that a dollar would actually get invested in real estate is unlikely, heavily unlikely in 2021, from what I understand the process to be, and it's more likely to be in 2022 sometime. And so then if I were to say, what's the chance that we have a lot more knowns on real estate between now and 2022? Very high. And what's the chance that we're coming out of the economic situation we're in by 2022? Very high. And so what's the chance that the real estate industry, even on the private side, will take, the write-downs that will happen between now and 2022? Also relatively high. From my perspective, these things are longer term. You don't want to time. It's really hard to do that. But by the time we get actually money invested, chances are the recovery will be into the recovery.
I think, are you waving your hand, Matt?
I'm just nodding in violent agreement.
Any other thoughts by anyone in terms of, we've sort of put the pause button on at the last meeting. Do you want to continue the pause button, or should we send Aon back to the drawing board and saying there's too many questions around this asset class, and is there something else, or does somebody have the appetite for blind pools? Don't all speak at once. Are you just waving your hand again, Matt, or?
Well, the one thought I did have was around, I know a lot of the large private equity firms have put together, funds that are sort of opportunistic and levered to, recovery. So sort of building on Colin's theme, they're not necessarily or strictly wedded to, a particular asset class. They're sort of, their plays on kind of the broader theme of economic recovery and some of the opportunities that have presented themselves through this crisis. And for instance, I know KKR, Apollo, Blackstone, they've all put out, offerings in that regard. So I don't know, Brian, if that's any of those are currently on your shelf, or if you guys have capacity to look at those. But something like that might be an interesting way to play, the themes that Colin was sort of referencing. Just a thought.
So let me just address that. At the end of the day, when we originally did the modeling, the two asset classes that really came up in terms of the real return strategies that were appealing were infrastructure and real estate. And in the end, we decided real estate was the better option to go forward with. And I'm not trying to make a statement on that. We actually did produce a report, and certainly we can update that. But what we're looking for is managers that basically can act when it's appropriate to act. I'm not sure we want to be super opportunistic in terms of how this money is deployed. We looked at real estate because it fit into the diversification want. And so if we were to go to, for example, private investments and things like that, it would change the dynamics in terms of the risk profile. So, but that being said, we certainly, if the committee is in agreement, I agree with what Colin has said. It's going to be some time before the money is deployed. And it's in these times that, you may want to think through and consider the different opportunity set of managers that are worth consideration, educate yourself on them, meet with them, that sort of thing, and then ultimately make a decision on how to go forward. So it's a long time between now and when the money would actually be committed. So I think we could use it to look at different opportunities.
Colin?
So personally, I would agree with that. I think that there are all sorts of different strategies everywhere. I'm just coming up to speed, so I was reading a bit of the background, but it looked like we started with a Canadian sort of strategy and then moved that to a North American / global. And so if that's a geographic remit, there's a whole host of different strategies out there, and different ways to sort of, and if the view is that we should continue looking at real estate, there's a whole host, and there's different options, and probably there is a bit of sort of acclimatization process as to what's available and what's out there. So to me, it would make sense to do that. Only because by the time the process actually rolls through, we'll be into the recovery. And if we're not, the whole world's in a bad place, and many asset classes are going to be challenged. So I would presume we're going to be into a recovery, and many of the questions we talked about we'll have a lot more answers to.
Anybody else want to contribute to this? Mary, go ahead.
Actually, hi. Sorry if you don't mind. A question, Brian, Colin, Carlos. Real estate relative to infrastructure. So we've really been focusing more on real estate, but we still do have the infrastructure in the policy. And has your view on infrastructure relative to real estate changed in terms of the prioritization? Thank you.
It's a good question. I think, so infrastructure also presents an opportunity as well. You'll recall that when we talked infrastructure for this particular pool of assets, we were looking specifically at open-ended infrastructure. So closed-ended infrastructure was not appealing, and because of the liquidity constraints. There are some funds that we're continuing to work with, and the one thing I would say is that one, there is opportunity. Two, we do continue to sit, wait, and watch. Because infrastructure can look very similar to real estate in many respects. So, but I think that they're both good options at this point. And I think that it's time well spent. If there's an appetite for infrastructure, and just, does the committee want me to back up and just explain the difference between infrastructure and real estate, or are people comfortable with that?
Go ahead.
Comfortable? Good. I would suggest at this point we probably would be good to stick to what we were doing before, and that is taking a look at the real estate first and seeing what's in the opportunity set. And if that starts rolling, then we could probably introduce infrastructure after that if there's an appetite. But I would continue to start with the real estate.
Thanks, Brian. Again, any further questions or discussions? Do I have the sense of the meeting then that you would rather continue the discussion we had last time, that is, ask Brian and Carlos and others just to keep a watch on things? We know there's going to be developments, as was touched on. There's probably going to be a lot of write-downs in the next little while. There may be a lot of bankruptcies in January as people get by Christmas and take organizations down, and we just continue holding dry powder. Is that what I'm reading in terms of the discussion here? You're nodding your head.
Yeah, I think.
Sorry, Colin?
So I agree. I was just going to say I agree while the process of educating ourselves happens.
Okay, then, just in summary, then I guess the instructions to staff and Brian would be to continue, and Carlos, continue to monitor what's going on, write-downs, new opportunities, et cetera, and we'll continue this discussion at the next meeting. And the sense seems to be this may stretch out even into 2022 as we see how the office sector evolves, retail evolves, et cetera. And I think I missed Heather with her hand up, so apologize.
Mr. Chair, I was just agreeing. I was putting my hand up in agreement.
Okay. Well, let's say the minutes will show that, and we can move on from this. Do we need a motion here?
Mr. Chair, it's Brian here. If I could just ask for a clarification point. Does that mean that people would like to continue? So we had a search that we were doing. Would people like to continue with that search, meet the managers, that sort of thing? Or would you just like to keep up to date on market updates as we did today?
I think the latter point of view, unless anybody violently disagrees. Okay, we need do we have a motion to adopt the item? I have a motion from Colin, his first motion. Good. Colin, all in favor? Opposed? The motion is carried. Fifth item is IB 9.5, Environmental, Social, and Governance Update. We have a staff report, and we also have Randy here to talk to the item.
Thank you, Mr. Chair. There's several parts to this, and I'm going to have to go back at the history. As you know, this has been going on for about a year. We had this special meeting back in May 2019 to look at ESG and update the investment policy. It took us a while to get it through City Council. There was a number of issues and concerns, but one of the things that came out clearly, both at the board level and with City Council, is that we need to monitor, we need to have some sort of way to measure ESG and to include it in our regular reporting, just like we would for performance or compliance to the policy. So initially, we had mentioned to the board that there was information on Bloomberg, and that we would like to first of all do a test of the current portfolios to see if there would be adequate information that we could use what was on Bloomberg. So this report deals with that, as well as we did some initial interviews with all of the investment manager firms and to talk about their ESG process and the various tools and resources used. This report points out that the issues, that there are issues around ESG scoring, and one complicating factor is the information provided on Bloomberg has really no ESG scores for government bonds, which of course we have quite a large portfolio on. We were also warned by Sustainalytics, who also does some of the work for the city on the debt issuance side as far as green bond and social bonds go, that the information on Bloomberg is very surface level, as they put it to us. As well, we had a few visits by the Bloomberg specialist in this area of ESG scoring. But also through the interview process with the investment managers, they pointed out several shortfalls, which I'll get into in a minute. You'll notice that the report does have several recommendations here that we wanted to convey to the board, and hopefully you agree with. And then finally, while we were doing our interviews with the investment board, with the investment managers, we got talking about the UNPRI assessment, which CCNL pointed out in their presentation this morning. So there is a confidential attachment of all of our investment managers and what they scored on that assessment. That was another condition of council, was that they didn't want to have managers that were saying they were all for ESG, and in fact they weren't. So, and the whole integration process of doing ESG. So we can maybe finish with that. But I'll just get into the recommendations of this report. First of all, we're recommending that an RFP be done to get a third-party information provider that could provide those metrics as in the area of ESG, and especially climate change and carbon footprint. We were told about several different sources for that. We also the second recommendation is to provide the results of the RFP. Once we do our evaluation on those providers, we'll come back with it. And then finally, the third recommendation is really about the confidentiality of the information in the confidential attachment number 1. But just going through the several points that we have in the comments section of this report, that first of all, we did want to show to the board what was available on Bloomberg. We condensed it down, and Table 1, you should look at Table 1 and 2 together. There's some scores there that we could get on Bloomberg. The first column is the ESG rank, which is kind of sort of a Bloomberg composite score. The next 3 columns are from Sustainalytics, which give an environmental percentile, a social percentile, and a governance percentile, and where they rank in their portfolios rank in those scores. And then the next column is also a Bloomberg ESG disclosure score. It's about, really, there's a scoring that's done on companies that are willing to provide an ESG report and disclosures regarding ESG. And then finally, there's an ISS quality score. ISS, you may recall, has been around for a number of years and talked to issues facing the companies, shareholder proposals, those types of things. But you really have to look at Table 2, which actually shows these scores are based on only what we could score. So when you look at the portfolios of CCNL and Leith Wheeler, who we heard from today, 2/3 roughly of their portfolio could not be scored, again, because they're government bonds. Primarily government bond. There's also, in order to do the scoring, they have to have a ticker symbol in Bloomberg, and these did not have that. Even the 3 global equity managers that we had, were somewhere between 7 and 10% that could not be scored. So the numbers in the Table 1 really are really inconclusive, and are probably not, they are not a good indicator of what the portfolio is as far as ESG, and it doesn't get to some of the deeper areas of carbon footprint and GHG and that type of thing. I did want to point out that we do get some newsletters from each of the managers, and attachment 1 and 2. Attachment 1 is from CCNL, which was partly in their presentation today, so I won't cover that. But attachment 2 you might find interesting, and when I get these in from the managers, I will circulate them to the board members. But I wanted to point out on the attachment 2, which is from Fiera, and you may recall they're our latest global equity manager we signed on in February, their global equity fund, that on page 3 of that report, they do a pretty good analysis. There's a chart there showing the global equity strategy, weighted average carbon intensity attribution versus the benchmark. So they've taken their benchmark, the MSCI World Index, which has got a carbon intensity score of 167, and then over to the far right side, the blue bar, they point out that their portfolio only has a carbon intensity score of 33.2, about 20% of what the index is. So this is the kind of information, we get it sort of in drips and drabs right now from the managers. This is an example of one, which we're happy to pass on as they come in. If everybody's okay with that, just let me know if you're getting them and it's too much information. But that's what we're trying to work through, and we had lots of questions for Fiera. They were very helpful when we talked about scoring and how they do it. Just about all of the managers pointed out, I just want to talk about shortfalls, that none of them use just a single rating score, and that they really do it by committee, looking at maybe the score as an initial source, but then they work through the various parts of that score to come up with their own internal score. And again, it's usually committees comprise the different parts of the firm that come up with it. Some of the things they pointed out to us for single scores from these providers is the lack of transparency in rating methodologies among the raters. Second, there's a disparity in ESG rating of the same company or issuer among raters, around these providers. Actually, one of our managers provided us a document called Rate the Raters. I almost attached it here, but it was quite lengthy, and I thought it wouldn't be fair to you. But if you would like a copy of that, this report kind of goes through examples of the different rating agencies, these third-party information providers, and how the disparity between them. Third is the lack of ESG data and information produced by issuers and company. This is again sort of coming back to the Bloomberg score about having good data to make a score and how they get the score. And that, and you hear this about credit rating finally, that ESG ratings are largely backward looking and do not give due credit to companies or issuers that are transitioning or investing to improve ESG aspects of their businesses, which a lot of them felt this should be considered. So, although we heard of this, and our firms, spend a lot of time, energy, and money and resources on developing and looking at these companies, they did, warn us that single ratings have some pitfalls. However, given our job here at dealing with the board and with council, we think that the best way to assess, is to have some sort of third-party ESG information provider. And although there might not be perfect, that they will provide some information that could trigger further investigation by the board and questions. So our recommendation is to start a request for proposal for a third-party information provider. And again, we'll provide the results of that RFP and our evaluation in one of the coming meetings. I'm not sure how quickly we can get it out with you working through our purchasing department, but we're going to try. I'd like to have this information in place at least in the first quarter so we can do the year-end portfolio. Finally, I just want to wrap up by talking about the investment managers and the UNPRI principles and the assessment that was done. And of course, on the final page of the report, you've seen this before, the principles that any of these signatories that sign on to UNPRI have. And and what they promise to do. One of the criticisms of UNPRI has been that there's been some weak players that get involved here. So UNPRI started doing assessments now on each of these signatories, and so we asked for the scorecard. You saw CCL at their presentation. And so there's a confidential attachment 1 that gives a table with all those scores. I'm not sure if you'd like to go into closed session to deal with that. I'll stop my remarks there. But if you'd like to take a look at it, and if there's any questions on that, we can handle it at that time. Or hand it back to you, Mr.
Thanks,
Chair.
Randy. Are there any questions of Randy on this matter? Does anybody feel a desire to go into closed session on the confidential item that was sent out? Well, seeing none then, could I have a motion to accept Randy's proposal? Heather, thank you. All in favor? Adopted, thank you. Before we go, Sylvia has kept me in line parliamentary-wise, and if we could just go back to item IB 9.3, we passed a motion which amended the item, so we just need to take a vote on item IB 3 as amended. And all those in favor of that, could I have a show of hands? Carried. Thank you. I guess that concludes the business for today. We're just 12 noon, so thank you all, everyone. And at this point, we're still on schedule for the December meeting, probably in the same kind of setting. Normally, we would be starting to talk about next year's schedule, but as Heather will know, everything starts here with the City Council and the Executive Committee. They're the top of the pyramid, and the rest of us fall well below that. So once Council sets their agenda, which is and timetable in the time of COVID, then the rest of us can follow suit, and we're a little uncertain as to when that will be, but probably in the next month or two, and we'll keep you abreast of that. Any other thoughts or comments before we close the meeting? Sharon?
Yeah, I just wanted to say welcome to Colin. I think I haven't had a chance to meet you, and it's unfortunate you having to join on Zoom and not in person, but I think you're going to be a great addition to the board, and I'd like to welcome you.
Well, thank you very much, Sharon.
Heather, did you have something to say?
That was exactly what I was going to say as well. So welcome, Colin. Nice to virtually meet you.
Likewise.
Okay.
Thanks, Sharon.
Thank you very much, everyone. The meeting is adjourned.
Have a good day, everyone.